Hello, 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 hello. Welcome to the Applied Finance Workshop. Today we are going to do a bit of revision and a bit of new work. And to start, no, we are going to skip how are you feeling today. Today we have to feel fine.
No, we can't skip. We have to.
Oh yeah, okay. Oh, let's go. Sorry. Okay, how are we feeling today? Put in the chat. He's not allowed to skip. How are we feeling today?
Yeah.
Let me. We should always do the same things, the traditions of the elders.
Yeah, you can't change the traditions.
Good, all the above. And
even if the doctor is not feeling great, he must always ask.
You know what happened at 4:30? I finished. There was no problem. 4:37, client phones. They can't do what they were supposed to phone me about. The whole day I wasn't too busy. Okay, but it is what it is. Tobeka. Okay, good. She's feeling good. We are going to do easy stuff first. No, I shouldn't say easy stuff. Last time I was crying because it wasn't as easy as I thought. Okay, ladies and gentlemen, if you want to calculate weighted return, weighted return, you are going to say weight times return. So like weight to say what is the proportion of this type of investment times the return of that type plus, okay, so like this. Where is the pointer? Yes, there, like this. So here we are saying 40 times 15, which is what you see here. 20 times 9, which is what you see here, plus 40 times 3. Then if you do that, plus, it gives you 9%. That's how you calculate weighted return. But you know it's never enough if we don't do practice. So we are going to practice. Yours is this one, these two. So the weight here and there, the mining shares, let's say for there. Oh. Do you have mining shares or do you hold mining shares, let's say, or mine or gold in as a metal? Is you have your gold and you're not sharing some secrets?
No. I'm talking this side. Yeah, they do give. We have
Some shares.
You know that the shares as a management. Yeah, we do. We look at that number. Yeah. Yeah.
I'm sure these days you're smiling.
Yeah.
Because I saw gold is good. Like I think was it like yesterday when it went up by 6% or something. I say, wow. Some of us are just suffering for nothing.
Yeah.
Okay, ladies and gentlemen, okay, do that one and put in the chat.
Yeah.
Hi, Moffat.
Hi, good evening, Doc. How are you?
I'm good. How are you? So we are just doing this one. Yours is the red one. So we are just saying, my example was there 40 times 15 plus 20 times 9 plus 40 times 3 to get us an answer there.
Okay.
So you do your red one. See if it comes with the 7.1.
Yeah. Okay. 55 by 2.
Let's see how I'm going to share this spreadsheet. Okay. Yeah. Okay. We can still work, even though we are limited because of one laptop.
It's 7.1. Oh.
7.1.
Hello.
Tobeka, what did you get?
7.1.
Tobeka. You are not talking anymore. Not talking to us. Who shouted at Tobeka? Obviously, it's Leseho. Obviously. The man with gold shares, so he's shouting at everyone. Okay, let's go. Tobeka is not saying anything. Next. So now in a similar, you know why I'm doing this? Because the last time when we met, we were struggling with with this concept of weighted cost. So now let's start with the weighted return. So now we're talking about weighted return. That was the realized return. Now we are saying expected return, which is future return. So because it's future, we are not certain. So we use the probabilities. So we say there's a 40% probability that the economy will do very well. That will be a boom. There's a 50% probability that the economy will perform normally. And if it performs normally, our return will be 10%. There's a 10% chance that there will be a recession. And if there's a recession, our return is that. So what is the expected return? To calculate expected return, we are saying probability times individual return. So I'm going to say this summation probability. So I'm going to say this times this. Okay, what we are going to actually do is this. 0.4 times 15, 6, which is the same as that. 0.5 times 10, 0.5 times 10, 0.1 times 2, 0.1 times 2. So if you say 0.1 times 2, you get 20, then it gives you 11.2%. And this is yours. So do this calculation for B, and then you can do for C. So this is the probability for B, this is the return for B, this is the probability for C, this is the return for C. Do that, and if you finish B, you post, and then do C, if you are very fast. So that the more you practice, you know, ladies and gentlemen, the more you practice, the better. And if you're standing clear, you know the rule. Standing clear, you can unmute yourself and ask, or you can post in the chat the question. I'll see it. Okay, see for today is doing well. Did do C, PC and RC, probability C and return C. Okay, the second is doing fine. Moffat. Oh, Tomeka. Looks like Tomeka knew that I wanted to say something.
Yeah, I got you, Doc.
Yes, you got me. Okay. Moffat, anything? Are you struggling with anything there, or you are fine? Okay,
I'm fine. I'm just using my phone for the.
Oh, for the calculation. Okay,
Yes,
let's just check if we are. Today we are really suffering because we can't see. Let's try technology. Let's try to use technology to the max. I just want to make sure that we get the right answer. Okay, minimize. Slide number 4. I don't like this whole thing is just a mess. This whole thing of working without a second screen is just a mess. A real mess. So it's slide number 4, this one. And now we have to remove this red one. So that I just want us to make sure that we get the right answer. Then we put it on the right like that. So let's just create a thing there. Equals to open Tomeka saw that I was going to comment. He said, okay, let me just shut his mouth. Big mouth. 0.4 times 7 plus 0.1 times minus 1 close bracket. Yeah, okay. So we are all good. We are all good. So let's go back to our slides. Nicely. So let's put it back here because I know I will not come back here and I will send you messy slides. Let's go to the next one. We say we did weighted return. This one we did. Okay, now we don't panic. We are back to weighted average cost of capital. Okay, bear with me, like what they say. Bear with me. Let's do this pointer. Let's do it slowly, okay? So a company is financed 1.5 million ordinary shares, 900 preference shares, 500 debentures, 300 bank loan. Next line. Ordinary share is expected to give a 20% return, preference shares 10% return, and interest on debentures or yield to maturity is 12%, while the bank loan is 10%. Tax is 30%. What is the weighted average cost of capital? So the first thing we do is to say, what is the total capital? So we are saying 1.5, you can see the 1.5 ordinary shares, 900, we're just adding. Nothing clever here, 300. So if we add everything up, it will give us 3.2 million. So now we are to find the weighted average cost of capital. It's like weighted return, like weighted something. So we are saying here, ordinary shares, 1.5 divided by 3.2. This is the 3.2 times 20, the return. 900 divided by 3.2 million, 3.2. 900 is this one times 10, which is this cost. 500 debentures divided by 3.2 obvious times 12 times 1 minus 3. Times 1 minus 3, remember the tax 30%, because debenture interest or yield to maturity enjoys a tax benefit. So we are reducing it by the tax benefit. This is something which we did last time, and I don't, for some reason it was just confusing. 300, which is this one, bank loan divided by 3.2 total capital times 10 times 1 minus tax gives us everything. When we put everything in, 14.16%. Is it clear? Is there anything which is a little bit confusing there? Because you know the next thing, what's going to happen. Happy. Next. That one is yours.
Please, Doc.
Yes.
Yes, please explain, starting from the debentures to bank loan. Please explain from there. You were breaking up.
Oh, I was breaking up.
Yes, so on my side.
On the debentures there, you see this. Do you know where this 30% is coming from? The 30%. Tomeka, you can't be on mute now because let's talk.
Oh, yes, I see.
Yes. So this, you see, this is the tax.
Yes.
So we are just trying to reduce the 12% by the tax.
Okay.
That's why we're saying 12 times 1 minus 30. Because remember, interest is paid before we pay tax.
Yes.
Which is exactly the same thing we are doing here.
All right.
Anything else which is still unclear?
No, it's clear.
And here we are not doing it. It's clear. Okay, so now yours is this one.
So this debenture,
yes.
So debenture are tax payable, deductible. I mean.
Yes, the interest is tax deductible. Yeah.
Oh, okay.
Same as the bank loan, that interest is tax deductible.
Okay. 1.5 bank loan, 1.5 million.
So when you find the total capital, please post it in the chat so that I can at least see some progress.
One total capital.
Yeah, total capital. Yeah, just when you find the total capital, post in the chart, and then you start fighting with the weighted average cost of capital. Are we getting closer to the answer?
Yes.
Okay. So 2 more minutes. Moffat is 11.8. I don't know whether it's right or wrong because I didn't work it out. That's how confident I am. Okay, let's get another one. Sivu, how far are you from the answer?
I'm not too
I'm
far. I'm
working.
not too far, though.
We are too far, okay. 1 more minute. Now, because I have one screen on the laptop with the document with the files, so I can't prepare anything in the meantime. Without okay, let me in the meantime so that let's do this thing together. Well, there we go. We need to look for this one. Where are we? We need to look for this one. Okay, escape. Escape. So this is where we are. We are going to copy this. And we're going to just drop it in Excel here. Put it on the side. And put it here. Then we're going to do that. Then we're going to do that. Okay, let's say we'll put it in the table there. Oh, you put 5%. Okay, so I don't know. Okay, let's
It's wrong.
I
don't know.
I don't know if that's
Maybe
right
my
or wrong because
calculations
I didn't work it out. Yeah, just confident with it. Let's get another.
I worked it out.
See, we'll post your Tomeka, post your answer there so that when we get there, we are confident. Post your answer there while I'm just capturing information. So we are going to say ordinary shares, preference shares, debentures, bank loan. Then I'm going to try to be a perfectionist. I'm going to say cost, then after tax cost, yeah, okay. So we are going to pull everything out like that. Then we are going to say value here, value here. So ordinary shares, 5 million, 1, 2, 3, 1, 2, 3. Preference shares, 2.5 million, 1, 2, 1, 2, 3. Debentures, 2 million, 1, 2, 3. Bank loan, 1.5 million, 1, 2, 3. Let's just make sure that we are doing fine like that. And then we sum everything equals to sum. I'm going to be very nice to myself. Ladies and gentlemen, I'm going to be very nice to myself. I'm going to calculate the weight here. Divided by 11. And I'm going to anchor it nicely here, put it anchor there. Then I'm going to copy everything. So now I found the weights. Cost, okay, cost before. So I told ordinary shares 15%, 12% preference shares.
Just 2 decimals, is it always good or must we leave it that way, the weight?
Oh, that's a good question. What I'll tell you on Sunday is you should only round up when you round up the next when you get to the answer. Otherwise, leave it as much as you can.
Okay.
That's the response I got from the college. 11%. Okay. So we are going after tax cost. We know that for ordinary shares and preference shares, it remains the same. Here, I'm going to say equals to that times 1 minus 0.4, because I think it takes is 40% there. And I'm going to do that. Okay. Now, let's see. Is it 11.83? See, and Moffat are saying 11.83. Let's say you should be scared. Tomeka, what did you get?
No, I haven't arrived at the total answer, but I was coming a long way.
Okay. Equals to, so wait.
I'm just slow.
You are just slow.
Yeah.
You are not like these young men who are in this class.
Yeah, hey? Yeah, no?
I'm sure Lesego is like 32. I'm turning 30 tomorrow.
I just went back to 29.
Oh, yeah.
Happy belated birthday in advance.
Oh, thank you. 86. You see,
What did I do
Moffat,
wrong now?
I don't know what you did wrong there. Moffat and Steve, you are close to the kingdom, but I think you rounded up too early.
Yeah, I think it's my rounding up.
Yes, rounded up too early. Okay, any questions?
Yeah.
Okay, are we happy so that we can continue moving? Okay,
Yes.
save, and I'll move this one to here. So what was happening that day? Why were people struggling that day? I don't know what was happening that day. I really don't know what was happening. So now this is brand new. This is a relatively new material. You are the chief executive officer of Amazon. Thank you. You want to expand in the South African market like what they're trying to do now. Thank you. Why would you be interested in buying Take-A-Lot? That's an open question. Why would you be interested in buying Take-A-Lot? Sivu, why?
That's the competition.
To reduce the competition.
You have to close the competition.
Yeah, to kill the competition. Why else? Why else? Who else? What other reason? The other reason is the Take-A-Lot actually understands the South African market very well. So you might buy into it so that you can buy that intellectual capital, so that you don't have to relearn. In the US, you can do drone deliveries. If you do drone deliveries here in Durban, that drone is not gonna go, it will just does one delivery and it will be mine. I'm keen for them to do that drone delivery. Then I will have a drone to play around when I go on holiday. So the reasons why they would buy, okay, let's look for the pointer maybe to help. Rapid expire, increase market share, eliminate competition, get experience marketing. So there is a word. What is the popular term for the advantages which arise from acquisition and mergers? There's a popular term. Annoyingly popular. What term do they use? What do we normally use? When your organization, what do they say?
Acquisition.
Okay, but what do they say? We are going to buy into this business because of, there's a popular management word. Jomega?
Competition.
No,
Is
there's
it
a
competition?
popular word. There's a popular word which they use because they want to explore synergy.
Synergy. Yes.
Yes, synergy. That's the way their word. Synergy. So you're going to see that word a lot. So there are different types of synergies. There's what we call the operating synergy. Operating synergy is to say you combine two organizations and you reduce costs. Or you combine two organizations and increase revenue. Combine organizations and you increase market share. That's operating synergy. So how do we value a company? It's simple. Let's say for this one, Villa Limited is 2 million shares in issue and its current market price is 4 rand per share. What is the total market cap or market value of that company? 2 million shares times 4 equals to 8 million. Okay, this one is yours. Harvey Limited is 4 million shares in issue. The market price is current. What is the market capitalization in rands? That's yours. Post in the chat. Probably I think but I just want to make sure that we know how to calculate this before you see it in more, there will be so much English around it. Okay, let's get another answer there, guys, so that this is to just give me confidence that you know how to calculate it.
My zeros okay then.
Yeah, okay, so
It's too much zeros there by me.
80 million.
80 million, eh? Yeah.
80 million, because the 2,000 cents is 2 rand. It's 20 rand. It's not 2 rand.
That's 8 million, not 80 million.
80 million, yeah. 80 million. Okay, but you know what will be that was just unnecessarily tricky there. Okay, so it's 80 million. So that's how you find the market capitalization. So now they say take over premium. So to convince a company to sell, or to convince shareholders to sell their shares, you have to offer them something more. So if the company share is trading at 2 rand, maybe you say, I will pay you 2 rand 50, so that you can sell me the company. So that additional amount which you are giving out is called a premium. So calculating a premium is easy. It's the price you pay less the market price. So if the share is valued at 2 rand and you pay 2 rand 50, the premium is obviously 50 cents. Okay. Sitole Limited wants to acquire Mpumalanga Limited for 9 million. Mpumalanga Limited is 2 million shares in issue and its current market price is 4 rand per share. Calculate the takeover premium. Easy, 9 million, which they want to buy with, less 4 times 2, which is close to 1 million. So the takeover premium is 1 million rand. Of course, yours is next. Yours is next. Post in the chat. Remember, you were posting in the chat so that I'm a little bit confident that you know what's happening. Because one of the big challenges in teaching is you come to a lecture thinking, oh, these concepts are easy. Meanwhile, they are easy to you. Okay. Meanwhile, let me go fetch some water. Okay. I am back and I'm seeing some answers there. 41 million, 41 million, 41 million, 290. Oh, okay. 41. How did you get that number?
No, I don't know when you get that number. My ex is that 300,000 or 300 million?
Yeah. 300,000. The premium.
Oh, okay. That's where the problem is.
Or you find
Mr. How much is this amount that you're retaining?
I don't know.
You are willing to pay 300
Okay, now I got
million
it now.
as a premium.
I don't know where that number.
Okay. Now let's talk about what they call the NPV. This NPV is slightly different from the NPV we're calculating or we will be calculating. So the NPV, when we are talking about acquisitions, is equals to value created, that synergy we're talking about, less the extra premium paid. Okay, let's see. Oh, go to spreadsheets. Okay, we have to agree with this spread. Oh, go to spreadsheets. Okay, come out, go to spreadsheets. We can't disagree with it. So NPV. So now we are because we are using a small screen. That's the problem. The small screen. Let's do this. The small screen is a problem. It's better. What time is it? 13 past. Let's send to this one. And then say spreadsheet. I want to send to the others, to the other one which has access to the big screen, because the big screen to make it easier for you to see. Where is my this one? And I'm hoping against hope. It's called, what is it called? It's called Mergers and Acquisitions. If you see it here, it is 52502 is that the correct one. It will refuse because it's open here. We are going to close it here, and now it should work. The open, and we are going to say send. And if we come here, I don't know why I'm still sharing here, because we are going to the other screen. Where is the stop sharing? Okay, I'm not worrying about that. Now I'm just worrying about useless things. I want to use the big screen. Because big screen means it's easier to see. I don't want us to struggle for today is promising. I don't know why everything is trying to be hard. I really don't know. Now all of a sudden it doesn't want to go to the folder which is supposed to be. Okay. Oh, okay, let's see. Let's see if I get that. Yeah, okay. The gods of technology willing. The gods of technology willing, it will open on the other screen. And looks like the gods of technology are trying to give me a very hard time today. Very hard time. Enable editing. Okay. I'm going to share from here, share that, share screen 2, that one. Okay. And we are going to go to here. Okay, let's say, can you see? Can you see the spreadsheet? If you are talking, I can't hear you.
No, nothing is showing now.
Nothing showing. Maybe I didn't share. Let's see. Oh, now it's showing, I'm sure. Anything showing?
Yes, it's showing now.
Now we are
Yeah,
business.
now it's showing now.
Okay. Okay. Okay, now I have to switch the laptops. Okay, now we are in business. This one out of the way. And now I can do some work. So NPV here is to say, the simpler way would be to say, so the NPV, let's start with the story. Line number 2, Aston Limited is considering acquisition of Villa Limited. The expected synergy is 8 million. Aston offers 9 million, Villa 2 million. Net, so calculate the net present value. So the net present value of the takeover, NPV, is equals to how much they are paying, the value, the synergy. I want to do the easy one. So we are going to say synergy plus value of acquisition less premium they paid. So we can say the synergy is given there, 8 million, 1, 2, 3, 1, 2, 3. And the value of acquisition in Villa Limited, which they want to buy, is equals to 2 million, 1, 2, 3, 1, 2, 3 times 4. The premium they paid 9 million, 1, 2, 3, 1, 2, 3. So therefore, the NPV is equals to that plus that minus the premium. So we are saying the value we are going to get for combining the two organizations plus the value of that organization less the premium we're going to pay for acquiring it is equals to our NPV. So then number 2 says advise if they should buy. So your advice would be to say they should buy because NPV is positive. Questions? Any question? So yours is this one.
So
Yours
the
is
net
this one.
present value for 2 companies will be 7 million.
Pardon me? No, the net present value for the acquisition.
Present value for combined companies will be for the acquisition.
Yes, for the acquisition
okay.
is not for the combined company.
Yeah, okay.
So we are what are we going to advise? We are going to say buy because the NPV is positive. So this was question number 1. Now it's feeling a little bit more comfortable because now I'm in familiar territory. Yours is this one. Okay, let's see what's happening here. I think it's clear. I think you can actually see what's happening there. So you post your NPV and then you give us your advice. Should they buy or not? Let me just clean up here since I'm just sitting here. Moffat says 54 million they should buy. I think you're onto something there. Let's go. Yes, so we are going to say I will need another someone else to post something else, additional information. How far are you, Lesego?
Yeah, the 7 million shares is the one that is tripping me. Maybe I didn't.
What to say? How did we end up with 7?
So the
this one
synergy is
just-
45.
Yeah. Value of Parker
So we need to
is
work out
7
what is
million
the
times
premium. Yeah.
the premium, isn't it? Do we say premium? No. I'm okay. Cash purchase. I'm misleading you now. That one.
Yeah, I
That was
see
supposed
there.
to.
We need to work out the premium because it's not given.
Oh, because you. Yeah, right. So the premium, then you have to just say the cash price minus the value of the acquisition. Then that minus the synergy. That's the answer.
Yes.
It comes to the same. It comes to the same.
Oh,
Yeah,
yeah, it
I
comes
just
to the
went
same,
directly
yeah.
for it. I went directly for it. Okay, so NPV. Now we are just going, and we are leaving Tobega. Tobega is ignoring me.
Yes, Doc.
Yeah, how far are you?
I'm getting something.
Okay, so we're saying let's do it two ways. Premium is equals to the value of purchase. Purchase price. How much did they pay? They paid 250 million.
Yeah.
Yes.
So we are
cash
going to say
yes, it's
payment, and then we say what value of Parker. So we're going to say they paid 250 million. 1, 2, 3, 1, 2,
The premium is going to be
negative. It's going to be negative. Is that what you are going to say? 1, 2, 3, 1, 2, 3 times 37. It's there equals to that minus that negative 9 million. Is that what is concerning you?
Yes, I got that. I was not sure where to put it.
You
I
got
had
the
it
right
in a
answer.
premium. Yeah.
So now we are going to say equals to. So our formula says value is equals to value is equals to synergy minus extra premium. So our synergy is what? 45 million. 1, 2, 3, 1, 2, 3 minus gives us a positive answer. Any questions? Minus. Or if you want to do what we did the last time, you can say, let's go, just come and this.
So you know what's confusing there? So what is confusing there for me is, so we are given the value of the acquisition 250, right?
Yeah.
That you have there.
But
so the value of the acquisition on your previous calculation there, see, it's a shares times 4, right? On your previous calculation. That is the value of the acquisition. That's how you put it there.
Yes.
You see
so
that?
The issue here.
So I followed the same one. So that's why I got.
What's confusing here is to say the company is valued at 259, but they sold it for 250. That's where the problem is. That's why we have a negative premium there, which is normally in the real world doesn't normally happen. Okay. Next, let's go to the next. Next, yeah. Yes. What other question? You have another question?
The synergy benefit 45,000. So I know maybe I just want to maybe clarify that where the 45,000.
45 million, yeah. So we are saying 45 million here minus 9 million.
Oh, okay.
To get the NPV. To get it. So because the minus, that's why it has gone up. Okay. NPV. Let's go to this one. Vivo Refiners wants to acquire, I'm here, line number 2. Vivo Refiners wants to acquire Rich Limited by offering to exchange shares instead of paying cash. Expected synergy is 20 million. So they just want to do this share swap. Don't pay anything. So what is the share swap like? Vivo will give 1 share of its own shares for every 2 shares of Rich. Vivo Refiners data is 8 million shares issued, market price 12 rand. Rich data 5 million shares, market price there. So the first thing is to say how many shares were given to, how many shares were given, which was buying Rich, okay, how many shares were given to Rich data shareholders? Remember, they are given 1 share of Vivo for every 2 of their own. So which means Rich shareholders got half or 1 for every 2. So which means they got how many shares? 5 million divided by 2. Divided by 2. So they got 2.5 million shares. But they got 2.5 million shares of Vivo Refiners, which means the price, Vivo share price, is given here. Vivo share price is 12 rand. 12. So they bought this business for 12 times the number of shares they gave out, which is our calculate the total cost of the acquisition. So this is the cost of the acquisition, 30 million. Okay. So what we did here, how many shares were given? They were given 1 share for every 2 of their own shares. So which means because they are 5 million, I'm just repeating now. There are 5 million shares in line number 6 here. 5 million, so they got half of their shares, which is 2.5 million shares. Times, because they got shares of the acquiring firm, shares of the acquiring firm's price is 12 rand. That's why we put here 12 there. So 2.5 million shares times 12 rand of Vivo shares gives us. So this is the value of the acquisition. Calculate the takeover premium. Same story. Premium is equals to the money, the value they paid less 8 million times 12. No, 5 million times 9 equals to 5 million, 5, 1, 2, 3, 1, 2, 3 times 9. So the premium which was paid was 15 million on this acquisition. Calculate the NPV. NPV still, we say what? The synergy, which is equals to, where is the synergy? 20 million synergy. 20, 1, 2, 3, 1, 2, 3, minus 15, 1, 2, 3, 1, 2, 3, 5 million. Okay, but let me check one thing. What was the value of this business? Equals to the value of this business was 5 million, was 45. Oh, okay. So we do the same thing. Remember that minus. Yeah. 35 million. It's confusing. Isn't it confusing? Or it's just confusing me who's trying to explain it? Okay. Do yours is this one. Yours is this one. Buy based on the market exchange ratio. Oh, then I'm introducing a new concept. I don't know what I was thinking there. Let's change the question. We will buy Spectrum. Let's change the question. We will issue one share for every 3 shares of spectrum, spectrum. Because that question, I didn't teach that question. That one, now that's much better. Okay, now I think this one is now doable. So do the number of shares which were issued, number 1, then you do what is the value of the acquisition. Eh? 600,000, okay. Value of acquisition 12 million. Okay, Moffat, let's go to the next. Cover the premium. Premium. Take over premium. An NPV. Okay, now I have 2 screens actually, so I can be more adventurous. Tables. I'm sending myself tables because I want to do the next question. I will need them. Present value tables. Why do we have another entry there? Okay, 2 more minutes, and then we can do together so that we can do something else. Tables, let me download the tables. I'm looking. Okay. I'm looking. Putting them there. Okay. 1 more minute. Okay, the minute is up. Ladies and gentlemen, let's see. Minimize that. They should buy. Okay, let's go. Number 1. So number of shares which were issued is equals to. So we are told, yeah, we will issue one share for every.
You sharing
Yes?
the old one? I don't know if you're sharing anything.
Let's see.
We can't see your screen, Doc.
We still see the question.
Okay, let me stop sharing.
Yeah,
I don't know what to do.
It was there.
No, not there we go. I actually stopped sharing now. Okay, let's see.
Maybe it's a signal on our side here.
Okay, now.
Yeah, I can see.
Omega.
But it's the same screen you are sharing. Do you want to share the same screen?
Yeah, I want to share the same screen. This one, you can see where
Okay. Oh,
okay.
yeah. Yeah, we can see.
Because remember we're doing this one. So number of shares, we are doing I4. We issue 3 for every of Spectre. So Spectre's shares are 1.8 million. So they are going to issue 1.8 divided by 3. 2, 1, 2, 3 divided by 3. So they are going to issue 800,000. 600. At what price? At the price of their share price is 20 rand. So at what price? At 20 rand. So the value of the acquisition is equals to. So the value of the acquisition is equals to the number of shares times the price, 12 million. And Moffat should be very happy with that because they were still good. So we go to number 2, takeover premium. Takeover premium is, we are told that takeover premium is because the price they paid, how much did they pay? They paid this minus the value, the synergy they were expecting to get 20, 1, 2, 3, 1, 2, 3, minus 8 million. But how did you get 16.8 million? I think that 20 million minus
Let's go
that
back
is
to the
8 million.
Go back to the calculation, Doc. I just want to see.
Which one?
The 8 million.
The 8 million there. It's K.
Yeah, how you get it?
So it's this, the value, minus the premium, which is there, which is in line number 3.
Okay, so it's 4 million times 2. Okay, sure.
Let's see. Yeah, okay, so that's the premium. Yeah, the premium is fine. So we go to number 3. The NPV. NPV is equals to NPV is equals to I made a mistake. I actually made a mistake. Moffat, you're supposed to say you made a mistake. So it's 12 million not minus 20 million. It's minus the value of the business, which is 1.8 million. 1, 2, 3 times 16. I think then your answer will be fine. Yeah. Moffat, you were right. Okay. NPV is equals to, that's where our 20 million comes now. 20 million, 1, 2, 3, minus. 36. I don't know where you got your 43 now. 36.
Now go to the
Questions,
premium calculation,
questions.
please.
The premium is to say what they paid, which is the value there, 12 million, minus the value of the business, which is here 1.8 million shares times 16. That's what it gives you, 16.8. We are agreeing there with Moffat, but where we disagree is the NPV. The NPV, 20 million, 20 million. Okay. Now let's just change gears. Now we are back to revising something which we did before. Omega. Anything?
I'm following, Doc.
We are following, okay. Now we are going to do something which we did before, changing gears so that we close. I want you to really, this is something which I'm dying that you understand. Okay, let's see. I can see it's not changing there. It's not changing. It's not changing. I went to the next tab which says WACC WACC. Yeah, okay, now it's changed. Let's say, wait, did it change your side?
Yes.
It's changed your side.
Yes, it's changed, Doc.
Okay, good.
It's showing
So,
Savannah.
as usual, I'm going to do this one. This side, blue, you are going to do your Savannah there. Okay, let me push this one from me. This is to calculate the weighted average cost of capital. Now it's more closer to a question in which you can get in your case study or the exam. So the first thing we are going to do is to find the value of the different types of funding. That's the first step. So we are going to find the value of shares. We are going to find the value of ordinary shares. Ordinary shares. Pref shares. We are going to find the value of debentures. We are going to put the value of bank loan. And bank loan, we already know it's line number 8. We are already told it's 15 million. Is it 15 million? I don't know. Oh, 1, 2, yeah, it's 1.5. Put a comma here and there. So the bank already know bank is close to 1.5 million. It's given. Now we go to our ordinary shares, the value of ordinary shares, 2.5 million ordinary shares. Let me put a comma nicely. 2.5 million ordinary shares with the current price of that. So the value of ordinary shares we already know. I don't need to teach that. 2.5 is just multiply 1, 2, 3 times the 12. Preference shares, we are told here, line number 6. I think it's 500,000. If we put a comma there, 500,000, 2 rand, market value 350. Okay, so equals to 500, 1, 2, 3, market value 3. Debentures. Okay, now debentures, ladies and gentlemen, you remember the valuation of, now we need tables. So yield to maturity is 11%. So it's 8 million. I don't know where the 8 million is coming from. 8% debentures. So the debenture, let's put here. So the coupon, the debenture is paying a coupon of equals to 8% times 2 million. 1, 2, 3, 1, 2, 3. Let's just make sure that it's 2 million, this one. Let's make sure it's 2 million. So that's the coupon. So now, since we now have a coupon, we can go to our tables. Remember the tables? Remember the tables. We go to our tables and say, what is, so we are using 11%. So we are going to go and grab 11%. Is how many years? Debentures. There's something missing in this question, I think. Debentures 2%, they are currently trading it. When are they maturing? When are they maturing? No way. No way are we told they are going to mature when. Because if without that, okay, we are going to just do our own thing and say maturing in 5 years. And I am also sure that this one, debentures will not have a maturing. So I'm going to say maturing in 5 years. Okay, so that we can calculate. So we are going to go to our table. So it's 5 and 11%. Rep text. Then we are going to do this. So maturing in 5 years. 5 and so it's 5 and 11%. So 5 and 11%. We are going to say 5 and 11% in table 1. 5 and 11% is what's my table says 5 and 11% is 0.59. So it's 0. I'm just writing it here, 0.5935. Then in table 2, 5 and 11%. 5 and 11% is 369. These are the rates, 3.6959. So what is the value of this debenture? Equals to, open bracket, it will mature with 2 million, 123 times the present value in respect of an amount, 0.5935, close bracket, plus, open bracket, coupon, we already know this is the coupon we calculated, times, times 3.6959, close bracket. Do you want to do this on your side there? The values there, your side here. Or should we do all the way to the bottom? Now I'm talking to myself. Everyone is tired and quiet. Equals to sum, now that the total value equals to sum of that. So this is the capital. I'm looking at the time, I'm thinking we are going to run out of time. Then we are going to do that. So this is the value, the total value. Then we are going to go do the cost. No, let's do cost here. Cost, let's do the cost here so that it's easy. So cost of shares, we are told, let's start with the easy one. Preference shares, cost preference shares, 12, So what is the dividend of preference shares? So there is 10% 2 rand preference shares. So equals to, open brackets, 0.1 times 2 rand divided by the market value is 3.50 rand. Okay, I don't know what happened today. Why is it? Oh, because there is an additional minus there. So it's 5.7%. Then the debentures is easy because they were told the tax is 27%. So equals to 14% times this we did before. 1 minus 27%, we close bracket there. For bank loan, 14%, so I go equals to 14% times 1 minus 27%, close bracket. Oh, it was 14%, 14%, both of them. I made a mistake. This is 11%, not 14%. Okay, now we are left with this one. So here, why are we using the golden growth model? We did the golden growth model with that one, which says D1 divided by P plus G. So what is our D1? D1, we are told here, ordinary shares, 12, company recently paid a dividend 110%, the growth is 10%. So equals to, so D1, our D1 is equals to 1.1, which is 110 cents, times is going by 1.1.1, which is 1.21. So we come here and say equals to, open brackets, the D1 we already have divided by price. What is the price? 12 rand each, close bracket, plus what is the growth? 10%, 10%. So if we change everything to percent there and move it to 4 decimal places, then we can actually go for the answer. Now we can actually say equals to weighted average cost of capital using the golden growth model is equals to, open bracket. Okay, I want to be nice to myself. To be nice to myself, I'll add a column here for weight. Since I want to be nice to myself, weight of each funding, that's what we did when we started, divided by that. Then we are going to put a $sign here to anger it. Then we are going to copy. I think there's a mistake here. Shares can be, shares, was it 2.5 million? Did I make a mistake? Yeah, times 12. 2.5 million times 12 is 30. Yeah, should be. So now, what is the weighted average cost of capital? Equals to, open bracket, cost times weight for shares. Plus, this is what we're doing, and you were happy with that times that plus, open bracket, that times that, we did this before, plus, open bracket, that times that. That's using the golden growth model. But then question number 2 says, calculate the weighted average cost of capital using the capital asset pricing model. So some of you will redo the whole question, but no, the only thing you need to redo is this part. Actually, this part, only this part, the cost of shares. So we know that the weighted capital asset pricing model says the cost of capital is equals to risk-free plus beta, open brackets, market return minus risk-free. That's the formula. Therefore, is equals to risk-free. If we are told the current risk-free is 7%, 7%, plus open bracket. Now we want to be careful. Beta is what? 1.2, 1.2, open bracket. Market return, I'm looking here, market return 15% minus risk-free is 7%. Close bracket. I'm hoping this time I think I missed another close bracket. Yes. So the cost now we are going to use here is here. Now this 20 is replaced by 16.6. So now we are going to say weighted average cost of capital 2 is equals to weight, open brackets, weight this one times this new one plus open bracket, see second weight, we are just continuing like we're doing, plus open bracket that times that close bracket plus open bracket that times. So this is to answer question number 2, 5 marks, then you get your 5 marks. That's why it's 5 marks, because they are only calculating this thing. That's the new thing. Any questions, ladies and gentlemen? Well, the one hand was up long, big Moffat.
Yeah, I've seen the way you've done the calculations, but I was saying now the next work, is it necessary, or do we need to do it after it is asked? Or how often do they ask that? Because you just needed to end up on the calculation of the equity, isn't it, on the question number 2?
This one very often.
Okay.
They very often. Sometimes they swap to say calculate what number 1 because they screen 20 marks using the capital asset. So sometimes this capital asset pricing is at the top and this one is at the bottom. So that's that is very often. Very often. Any other question? Ladies and gentlemen, ladies and gents, this is our last workshop, introductory workshop. I hope it was worthwhile. And therefore, it's 7 o'clock, ladies and gentlemen. I hope it at least it opened up your minds to be able to now to jump in with 2 feet.
But yeah,
you just broke 1 feet.
Well, we jumped in, then the 1 foot was broken.
Doc, you can do a bonus one just to go through maybe one question later on. You can't just give us examples.